before we begin, I'd love to just hear an introduction from both of your sides and also an introduction to Stratos.
So I'm Laurent Parmentier. I've joined Stratos in 2022. You can think of me as pretty much kind of the COO of the firm. So I lead a lot of our portfolio support stuff, a lot of our internal operations, fundraising, marketing, and a lot of our deal sourcing as well. And prior to joining Stratos, I worked in venture capital for 6-7 years for a firm called Signalfire, which is based in the Bay Area. I joined when Signalfire was relatively early. We had a $50 million fund, and then over the following 6 years, grew that to $3 billion under management and 50 people. And so I was kind of, very much involved in kind of growing that team and growing assets under management there. I think when I joined Signalfire, we had 10 portfolio companies, and when I left, we were around 250. So it kind of led a lot of that growth, and then joined Stratos, which is a really an early stage venture capital firm focused on crypto. That was initially launched in 2016 by Rennick Paley. Rennick launched a firm in 2016 with a credit fund that was doing structured credit, mostly in fintech. And through his involvement with various different fintech companies, he started digging in more and more into crypto. He was already an investor personally in crypto since 2016. But decided to launch a venture fund focused on early stage seed deals in 2021. And so that was the first fund. We launched a second fund between 2022 and 2023, kind of at the bottom of the bear cycle, which we're pretty much fully deployed so far. There may be, room for one or two more deals, but we're more or less fully deployed at this stage. And so our sweet spot is, seed deals with $1 to $2 million checks. Really, kind of across the board in crypto. Do we have a preference for, token networks, layer one, layer twos? We're very much focused on just backing incredible founders. So that's kind of one of the key overlays on everything that we do. Try to take concentrated bets. All right. So we'll typically try to lead or co-lead rounds with checks of $1 to $2 million. So our portfolio tends to be relatively concentrated. So we're not a fund that will invest in 100 deals with 200K checks. We try to build relatively concentrated portfolio with lead checks in high conviction bets where we really like founders and the technology. So that's generally the background on Stratos.
Yeah, and I'm Eli Nuss. I'm an associate here at Stratos on the investment team. I joined back in 2021, kind of as we kicked off the first crypto fund as an analyst. I'm very, very focused on, I think, understanding the tech and kind of being more in the weeds with kind of founders and understanding kind of the lay of the land. Prior to Stratos, I was actually doing physics research. My undergrad was in physics, and I kind of was toying with the idea of doing a graduate program. And then I kind of got hooked on crypto and went down that rabbit hole. And I found investing is kind of a really good outlet for someone who likes research and also crypto. So I joined, and it's been a really awesome opportunity. So
it's been a fun ride so far.
Yeah. So since that point, around early 2017, how have you seen the space evolve? I guess from an investor, like a VC investor perspective in terms of the companies you're investing into, but also just from a blockchain infrastructure angle.
Yeah, I mean, I think clearly things have been much more institutionalized. I think there's kind of an industry here, whereas back when the ICO mania was happening, it was more of, there's always going to be speculators, but I think, there's a lot of founders and really impressive developers building, real companies today. And I'd say that really picked up in 2021, 2022. And, we've seen probably pretty steady growth overall in the early stage venture crypto venture ecosystem, probably going back to 2020. Obviously, there were peaks and troughs, but I think we're in a much, it's a much, more significant space than where we started. So
yeah, I mean, we kind of go through cycles, right? I mean, the 2017 cycle, you had this like crazy ICO boom, and I remember we were looking at that and we were like, this doesn't make a lot of sense. People were just like launching random tokens that were worth a lot of money at the time, and then you had the crash after that, and then it was all like, okay, Bitcoin's the only thing that really matters. And then we had DeFi summer, where people started getting interested again in the ETH ecosystem, and you had ETH really outperform like in 2020. And then you had NFTs, et cetera. So that kind of brought in like a whole bunch of new interest in kind of non-Bitcoin stuff in the crypto space. And then, OpenSea was once, I think, valued, I don't know the number off the top of my head, but multiple billions of dollars. And then, last year, the headlines were 99% of the volume on NFTs is gone. OpenSea is now worth, a fraction of what it was worth before. And now it's kind of like, at least most of the past year was just Bitcoin, right? And so now you have Bitcoin ETFs is kind of like in the mainstream media again. So you kind of go through these cycles of like, all that matters is Bitcoin to, there's a new shiny object, and then back to Bitcoin. And then I think, again, kind of this year, we're seeing things like AI and the modular stack and et cetera, kind of taking more and more of the narrative for these cycles. So it's pretty funny how crypto seems to kind of go back and forth between Bitcoin and other things that are relevant.
Yeah, I think it's probably a little unique in crypto venture that we have like probably closer ties to the public comps and counterparts.
Yep.
Where I think the prices in the private markets are able to react much more quickly than a SaaS company or Web2. So we were able to see a number of deals that were at major discounts over the past kind of year, and it's been really interesting just in really the last like three months, I'd say, to see a lot of like the private deals and like secondary deals that are now kind of either pricing it the same as the previous round or a lot of premiums to the previous round.
Yep.
And all it took was Bitcoin moving to 40K or so, and it really turned the private market around.
Yeah. If I can just add one more thing, like, because your question was like how we've seen things evolved as well, that I think has been really interesting from my perspective, is this idea of equity versus token value. So when we first started looking into the space, really, I think people were, or at least in traditional venture, worried about investing in tokens and wanted mostly to invest in equity, right? And I think what we've seen, things have played out over time is, or at least the way we look at it, is we heavily discount the equity value because the value in most of these networks tend to be in the tokens, not the equity. And so I think the industry has probably shifted from being very equity focused and almost discounting the tokens as, gravy on top. Like if the tokens go up and we make money on the tokens, great. But really we care about, investing in the equity, to now I think the sophisticated investors in crypto understand that the big returns tend to be on tokens, not equity. And we looked at some very interesting data recently where they compared the secondary data. So secondaries are basically transactions that happen kind of off market after a round of financing has happened, right? So let's take a company that raised, let's say, $100 million at $1 billion valuation from some top VCs at the peak of the cycle in late 21, early 2022. There's then secondary transactions that happen where someone can buy into that round either at a discount or a premium, from existing investors. If you compare the top deals in terms of equity and tokens, all of the equity deals in crypto are like way undervalued or way underwater, or way discounted, right? So for instance, if the last round was $1 billion equity value, today you can probably invest in that company at maybe 500 million or something like that, like a 50% discount. And that's for the top equity deals, right? That's like the top deals out there. Whereas for the token deals, if a token deal happened at $1 billion valuation, on average today, if you wanted to buy into that round, you'd probably have to come in at a $2-3 billion valuation just to get in. So the token deals have like massively outperformed equity deals in crypto over the last few years. And so I think that kind of shows you where value accrues.
Agreed. And how do you think about evaluating the tokenomics? Because we've obviously seen like a lot of projects that just launch a token with no utility behind it. How do you think about essentially evaluating them to make sure that value does accrue within the token?
Yeah, I mean, we've spent a lot of time, I think, trying to understand, why some of these tokens are valued the way they are. And I think we've kind of landed on a view of basically this concept of monetary premium. I'm not sure if you're familiar, but essentially the more, I'd maybe say like the more money-like that one of these tokens can behave, kind of the more kind of uncapped upside there is on sort of the value of that token. And so like Bitcoin's a really good example, right? Like there's no like way to fundamentally value Bitcoin. It's really just a function of, supply and demand. And so at the end of the day, I think, the reason we've seen kind of these layer one blockchain tokens really outperform is that within their own kind of like confined ecosystem, they behave as like their own form of money. And so when you're on Solana, you're paying for all the transaction fees with Sol, you're buying NFTs with Sol, etc. And same goes for Ethereum and so on. And so one of the kind of takeaways we had there is really, it's very difficult to, well, number one, it's very difficult to like outperform Bitcoin, Ethereum, because they have this kind of dynamic there. And then number two, we'd like to be investing in kind of tokens that have that sort of upside. And so we spend a lot of time on L1s and L2s and things that we think have that upside.
Yeah. And let me just add to that. So one concept we've been kind of thinking about is you can separate generally crypto or tokens into two categories. You've got kind of the base protocol layers, like the layer one and potentially layer twos as well. And then you've got the dApps, right? The dApps, in our view, are kind of like traditional businesses that should be viewed as, on the basis of the cash flows that they can generate. So you're thinking about revenues and profits, etc. Whereas for the layer ones, as Eli mentioned, you can view them as money, right? Just like Solana or Ethereum, you can use Ethereum to pay gas fees. You can also use Ethereum as kind of like your reserve asset, if you will. Like we have a number of portfolio companies, for instance, who hold a portion of their treasury in like Ethereum, right? So it's kind of like almost an alternative to the US dollar. For those that fall into that monetary premium category, like the ceiling is much higher. And so you evaluate those tokens on the basis of how strong of money they are, right? So Bitcoin is kind of the ultimate example. It's very easy to understand, right? Like, there's only ever going to be 21 million Bitcoins out there. You can kind of forecast what the inflation rate is going to be over the next 100 years. And like, that's very easy for people to wrap their heads around that, which is why today still it's like the number one largest token. And we think that's probably going to remain the case for a very long time. Ethereum is kind of maybe the next level beyond that. It's a little bit more complicated to wrap your head around that because it's partially a function of like how much activity there is on the Ethereum blockchain and what is the demand for block space for dApps, etc., which ultimately translates into like how much of the token supply gets burned or inflated over time, right? So the more activity there is on Ethereum, the more tokens they can burn, the more deflationary it becomes, the stronger of a currency it potentially becomes relative to Bitcoin or other currencies out there. So there's kind of that phenomenon at play. And then you look at something like Solana, which is today like on a fundamental basis relative to Bitcoin and Ethereum, it's more inflationary. But at the same time, it's probably where the most like it's the chain that's experiencing the most user growth, at least relative to like, obviously Bitcoin and Ethereum. And so there's demand for that, right? Because people are projecting like, okay, what if Solana becomes the most used chain out there? Like, okay, then you can potentially project, okay, if there's tons of demands for dApps and users, etc., then it becomes almost, potentially a good candidate for a monetary asset that can compete with Bitcoin and ETH, right? So that's kind of how we think about that. And then everything else that we invest in ideally falls again into that monetary premium category that can ultimately compete against Bitcoin, Ethereum, and Solana, and some of these other kind of layer one tokens as monetary assets. Because we think of crypto as almost like various different sub communities, right? There's crypto as a whole, but then you have, the Ethereum community, and you have the Solana community, and you have the Polygon community, and you have the Ripple community, and like all of these different communities at the end of the day really value the tokens that they're holding. And at the end of the day, you're almost competing for attention span from users. And so the chains that can, over time bring in new users and increase kind of attention span will continue to do well, right? And so that's kind of why we think at the end of the day, Bitcoin, even though from a technology standpoint is not nearly as interesting as some of the other stuff that we're looking at, we think that there's going to be an influx over time of more and more people looking at Bitcoin and being like, okay, I can own US dollars, and by the way, US dollars is probably the best traditional, or one of the best, maybe with the Swiss franc and a few others, like traditional fiat currency that exists out there. And that gets inflated, 7 to 10% per year, depending on how you look at that. Or you can own Bitcoin, which is still very early in its adoption curve, and it's inflating around 1% per year. It's got all these new users coming in. Like, which one would you want to hold for the next 10 years? Like, US government bonds or Bitcoin or ETH, that, gives you a 3 to 4%, staking yield, and is kind of like deflationary or more or less, or not really inflationary. I think our perspective is we'd much rather own, Bitcoin or ETH or some of these other things than US dollars. And so I think as more and more people kind of realize that fact, and as the space continues to grow and evolve, bring in users, and we've got these ETFs and things like that happen, it just legitimizes the space more and more, and brings in more users, and that's going to only make the prices continue to go up.
Yeah, I was just having this conversation with someone yesterday, trying to educate them around like traditional fiat currencies and why like cryptocurrencies are so exciting, because I think there is still a perception of crypto being a scam. I think that's less so now with like the ETF and everything. But I think once you like translate, I guess, what's happening or the dynamics of cryptocurrencies, people almost have that like aha moment where they actually get it. So I think we're getting there more and more. And then on like the infrastructure piece, how do you see blockchain infrastructure evolving? Because I know we've got like modular chains coming out now and all these, I guess, new L1s, L2s, or L0s. How do you see the blockchain infrastructure ecosystem evolving?
Yeah, I mean, this is another thing that we've spent a lot of time on, but I think we're probably, I don't want to say we're agnostic, but I think we're very open-minded to, whether it will be, kind of a couple chains like an oligopoly, or if we're going to see a really widely distributed ecosystem of like modular chains and rollups and all that. My guess is we're going to see kind of what we see today, which is kind of a combination of, you have monolithic chains like Solana, which, build kind of a top-down ecosystem, and everything's integrated and it's a very clean user experience. And then you've got something like Ethereum or Celestia or some of these modular chains that enable, kind of longer tail blockchains to exist. And for things like gaming and some of these other narratives that you've heard about, like, I think it makes sense that they don't need to all share the same state. So I think we'd probably expect some sort of an oligopoly, or I don't know if that's the right word, but sort of a not one winner take all, but a few
different use cases. Yeah,
really. Yeah.
Yeah, and there's this concept of like traditional Web 2 of bundling and unbundling, right? I think last cycle was the alt L1 trade where people were betting on Solana and a few others. I think this cycle, the modular narrative where you're taking different parts of a blockchain and like Celestia for DA and other things like that. I think that is going to be kind of a winning narrative this cycle, but I wouldn't be surprised if potentially 4 years from now the next narrative is, oh, now
Rebundling.
we have
Yeah.
all these different things, it's too complicated, and then we go back to kind of monolithic L1s again. And so I think that's just kind of the nature of kind of how things evolve. But I think all of these things can coexist and do well.
Agreed. And one thing that I've heard you mention a few times is having high conviction, which I think it's more prevalent in the Web3 space, but I think a lot of investors do lack conviction in the sense that they're putting their money where the narratives tell them to put their money rather than essentially having conviction, whether it's a team, a founder, a product, or whatever it is. How do you, like as a team, focus on that conviction and make sure you're making the right bets when there is all this noise around narratives, or where you like, I guess like Twitter tells you to put your money, all these kinds of different things, all these voices. How do you make sure that you're making those high conviction bets?
Yeah. First thing I would say is narratives, even for us, are still very important in crypto. You can't, even if you invest, let's say, in an amazing team that's building on something that nobody really cares about, you're unlikely to make money that way. So we can't just completely discount kind of the existing narratives in the space. Whereas, if you pick a narrative right now, like AI, for instance, where like there's tons of demand, and I think there's be tons of people looking at how can I invest in like the next crypto X AI thing that's out there. If you find a really good team that's legitimate, that's building in the space, like you should probably invest in that. So anyways, I don't want to discount narratives too much, but for us, what we kind of do is we have a set portfolio construction, right? That's dependent on how much money we've raised and try to figure out how many positions we want to invest in, and so that leads us to kind of have a super high bar in terms of the types of deals that we might want to do. So for instance, in a given fund, we may only have 10 to 20 positions, right? So over a 3-year time frame, if it's, let's say, 15 positions, we're only going to invest in 5 deals per year. So that's one every 2 months. So if we meet with 5 to 10 portfolio companies or companies per week, that means we're saying no very often, right? And so that is kind of almost, if you kind of restrict the funnel to a very small number of bets that you can make per year, that forces you to have very high conviction and to keep the bar very, very high. And so to us, when we make a bet, it needs to fit kind of the narratives that we like. We want to have very high conviction in the founders, right? And their ability to execute based on how well they've executed in the past, how well they understand the space, kind of their backgrounds. We want to figure out how we're going to make money at the end of the day. That's often kind of something that we spend a lot of time trying to figure out. And perhaps like in Web3, people just think, oh, I'm going to launch a token and I'm going to make money. Okay, yes, great. But we need to kind of gain conviction on that. And so there's a bunch of different factors like that we look at to ultimately gain conviction. The valuation needs to make sense. We try to go as early as possible, and so that means that we prefer seed or pre-seed in general. But so all those things are kind of forcing us to keep that high bar and come in with conviction.
At the end of the day, like we kind of like having a smaller fund because it really forces us to keep that bar as high as possible.
Yeah, that's one of the reasons I joined Stratos. I think when we I've seen too many venture funds that gain some success and then they grow very large and they start raising billion-dollar funds, and then that brings a ton of pressure to deploy capital. So you got to do more deals and then bigger deals to kind of deploy that capital. The great thing about Stratos is we want to keep the fund sizes extremely small. So I don't think we'll ever have fund sizes that are really much larger than $50 million at the most. And so that kind of keeps us very focused and keeps the aperture smaller and ensures that we come in with really high conviction and on deals that really passes our high bar with low valuations, large bets, etc. And I think that's, is kind of the formula that's going to help us hopefully generate very high returns over time.
That's really interesting. And once you invest in founders, what is, I guess, the most critical, but also, I guess, like diverse set of advice that you actually give your portfolio companies and your founders? So once you've already invested in them.
It's going to be very founder dependent. But I would say that if I were to kind of generalize, I would say that, building community in crypto is like super, super important. And I think that typically, the founders will invest in, or the founders that we'll find in crypto tend to be very technical. And so they love the tech, and, they can be, amazing builders. But at the end of the day, like, crypto is a combination of like good tech and then hype and community building. And so I think the general common thread, I would say, across our portfolio is that we're constantly pushing our founders, to build community, to build brands, to build hype around what they're building, and tell them like, hey, don't wait until, you've built like a Rolls Royce to kind of go out there in the market and basically speak about what you're trying to build. Deploy stuff, that's maybe not quite perfect, but at least start kind of building, generally hype and community around the stuff that you're building.
And in a quick summary, how do you recommend them to do that in terms of like building community? What do you think are like the top three, I guess, pieces you need to build a community?
I think building a brand on Twitter, right?
Yeah.
That's probably number one.
I think a way that we've seen projects really be successful is really one or two kind of, I'd say, almost key mouthpieces, or kind of, people to look to, that kind of are able to be a spokesperson for, their said project. And I think a lot of these extremely technical founders actually have the capability to do that, because they are really like, world-class experts in whatever field they're building. It's just taking the time to, go and engage on Twitter, which, a lot of them, probably have better things to be doing. But the reality is, like, they're probably the best person to really be explaining their product to the world and getting people excited about it. So, we obviously don't want to see them spending 100% of their time doing that. But I think, taking some time and setting that aside to really focus on their own personal brand, I think is a positive.
Yep.
Agreed. So before we finish off, what is like Stratos is, and I know that I keep saying that the Greek way, but what are your key focuses over the next 12 months?
Exiting positions. And I don't mean that in a bad way. I mean it. We've our portfolios are mostly fully deployed by design. I think, as I mentioned, crypto works in cycles, and so probably next year won't be the time to necessarily like deploy fresh capital at market highs. And so I think we work in cycles in which we deploy capital ideally at the bottom of the cycle, and then we try to kind of harvest some gains as the market makes new highs.
Awesome. Well, thanks so much. I feel like this conversation has been very refreshing, because I think there's a lot of intentionality behind, I guess, the investments that you make and how you think about investing, and that the market does move in cycles. Because I think one of the biggest things or the most common thread that investors tend to use when getting into Web3 is they tend to invest at the top when there's the most hype, and then obviously your fund doesn't perform very well. But I think it's been refreshing to also hear your guys' perspectives, because more funds need to be thinking about it from such an intentional, I guess, in such an intentional way, around market cycles. So thank you.
But to be honest, like, given that we invest in private deals in venture, pre-token launch, the cycles kind of work in our favor, because typically we'll be able to raise, money at kind of a top of a cycle
Yeah.
when they're very bullish. But like obviously it would be a mistake at that point to invest in like Bitcoin, ETH, and Sol, kind of at the top of the cycle. You wouldn't make money that way. But investing in early stage seed deals
Hmm.
is actually not a bad thing because
Hmm.
valuation still remain very reasonable.
Yeah.
And when you get to a top of the cycle, you get a kind of a new influx of entrepreneur that wants to come into the space
Hmm.
and high quality people. And then, these seed deals tend to take like 2, 3, 4 years to mature and ultimately launch it. So by the time those seed companies launch, you're kind of already into kind of the
Yeah,
next
into
market
another
cycle
cycle.
at
Yeah.
that point. So kind of, for a venture investor,
Yeah.
uh, it works in our favor.
Yeah. No. It's been a very interesting conversation. Thank you.
Yeah. Thank you for taking the time to
Appreciate it.